Justin is 51. He's sitting on his bed, opening a letter from his financial advisor. The advisor is recommending he move more of his retirement savings into stocks. Justin places the letter face down, slides it to the corner of the table, and leaves it there for 3 weeks. His coworkers think he is too scared to invest. His kids think he's old-fashioned. His advisor thinks he's leaving money on the table. And here's the thing. By every conventional financial measure, all three of them are right. But none of them understand why Justin does what he does. And until you understand that, you're missing the most important money lesson hiding inside an entire generation's financial behavior. Because when you trace Justin's habits back to where they actually came from, they do not look irrational at all. They look like the perfectly logical response to an economy that blew up in his face, repeatedly on schedule. The real question is not why Gen X handles money the way they do. The real question is whether those habits still fit the world they're living in now. And the gap between those two things, measured in real dollars, is bigger than most people realize. Let's start with who Gen X actually is. Roughly 44 to 59 years old today. About 65 million people in the U.S. alone. They're the generation sandwiched between boomers and millennials, the ones who get left out of every generational conversation. And their economic timeline looks like this. They entered adulthood right around 1987, Black Monday. The Dow dropped 22% in a single day, the largest single-day percentage decline in history. For a teenager watching the news, that image doesn't disappear. They hit their 30s, their first real wealth-building decade, just in time for the dot-com crash of 2000 and 2001. The Nasdaq lost 78% of its value. Retirement accounts people had spent years building got cut in half. Then 2008. Gen X is 35 to 50 years old. Mortgages, kids, peak earning years. The financial crisis wiped out an estimated $11 trillion in U.S. household wealth. Home values collapsed, jobs disappeared, and the people it hit hardest, statistically, were not boomers who had already built their wealth, and not millennials who had not yet started. It was Gen X, right in the middle of the one decade they were supposed to be building their foundation. 3 economic earthquakes before they turned 50. And then the world turned around and told them they were too conservative. Here's the first habit that drives everyone else crazy. After 2008, surveys consistently showed that Gen X investors moved more heavily into conservative investment allocations than any other age group. More bonds, more cash, fewer stocks, less exposure to market swings, at ages where financial advisors say they should still be aggressively building equity. On paper, this cost them enormously. The S&P 500 returned roughly 400% between 2010 and 2020. Investors who sat out that run in conservative funds missed most of it. The math on that missed growth compounded over 15 years is the kind of number that makes your chest tighten. But here's what that conversation always skips. A Fidelity study found that retail investors who panic sold during the 2008 downturn and bought back in after the recovery locked in losses at the bottom and missed the rebound entirely. Gen X had already done this twice before 2008 ever happened. .com in 2000, a smaller crash in the early 90s. They weren't being paranoid. They were pattern matching on 3 decades of lived experience. The habit was not irrational. It was built on something real. What changed is that time became the variable that flipped everything. At 35, a conservative allocation is protective. At 53, with maybe 12 years of compounding left before retirement, it quietly becomes the most expensive decision you can make. Not because markets always go up, but because inflation always goes up. And conservative isn't safe when your stable value fund returns 2% and inflation runs at 3%. The second habit. Gen X, more than any other generation, paid extra on their mortgage instead of maxing out investment accounts. And the math on this is not even close. If your mortgage interest rate is 4% and the market historically returns an average of 7 to 10% annually, every extra dollar you throw at the mortgage instead of investing is a dollar that works less hard. On a $50,000 extra payment applied to a 4% mortgage, you save roughly $37,000 in interest over time. That same $50,000 invested at a 7% average annual return over 20 years becomes approximately $193,000. That's a gap of over $150,000 from the exact same money. And yet, Gen X did it anyway. Not because they're bad at math, but because they watched neighbors go underwater in 2008 and lose everything the moment they lost their income. They watched people in the 1980s recession get wiped out by adjustable rate mortgages. A paid-off house is not just a financial asset. For a generation that watched home ownership turn into a trap multiple times, it's psychological insurance. The math says invest the difference. The memory says own the roof over your head no matter what. The shift here is not that the habit was wrong for them. The shift is that a 30-year fixed mortgage is a fundamentally different risk than what Gen X watched destroy people. The risk profile changed. The habit did not update to match. The third habit is quieter, but it compounds over an entire career. Gen X entered the workforce watching their fathers stay loyal to one company for 30 years, collect a pension, and retire with something stable. So they absorbed that model. Stay loyal, work up. The system will take care of you. What actually happened was that corporate America spent the 1980s and 1990s dismantling pensions and replacing them with 401ks, which shifted all investment risk from the employer to the employee. By the time most Gen X men realized the old contract was gone, they had already spent a decade playing by its rules. Studies consistently show that people who switch jobs earn on average 10 to 20% more than those who stay at the same company. Over a 20-year career, that wage gap doesn't just mean more spending money, it means more money available to invest, more years of compound growth, and a meaningfully different retirement number. The fourth habit, and this one is the one nobody wants to say out loud. Gen X prioritized funding their kids' college over funding their own retirement. And the intention behind that is genuinely admirable. The math behind it is genuinely dangerous. A student can take loans. A student can get scholarships, work part-time, choose a more affordable school. A 62-year-old man cannot go back and add 10 more years of compound growth to a retirement account. The window closes. You can borrow for college. You can't borrow for retirement. This is not a critique of caring about your kid's future. It's a math problem with a sequence built into it, and the sequence matters as much as the intention. Now here's the part the title has been pointing at the whole time, the until now. After 3 decades of being told their instincts were wrong, some of what Gen X built is quietly starting to look like prescient. Debt aversion matters more when interest rates spike. Cash reserves matter when markets turn volatile and income gets interrupted. Not being overexposed to any single asset class is exactly what traditional portfolio theory recommends as you get closer to retirement. The habits weren't crazy. They were calibrated to a world that kept punishing risk. The problem was that when the world stabilized, those same habits became the new risk. Not because the habits were wrong, but because the environment changed and the habits didn't change with it. And that's the trap, not the habits themselves. The trap is carrying any financial behavior from the world that built it into a world that no longer fits, without ever stopping to ask if the map still matches the territory. Gen X didn't fail at money. They survived at money 3 times over. What they're still working through is the transition from surviving to building. And that transition is not unique to one generation. Every single one of us is carrying financial habits that made sense somewhere, at some point, in some version of the world we used to live in. The question worth asking is not whether those habits were wrong then. The question is whether they're right now. If that question hits somewhere real, the next video is going to take it further than you expect.